Good morning and Jai Hind. In this video, we are going to learn about the remaining two turnover ratios. Trade payable turnover ratio. This ratio represents or indicates the relationship between credit purchases and average trade payable. That means we can calculate this by just dividing net credit purchase by average trade payables, and this represents in times. Here trade payables include the creditors and bills payable. The trade payable turnover ratio indicates the speed with which the amount is being paid. That means how fast the payment is made. If the ratio is high, then the situation is better, as it indicates the trade payables are being paid more quickly, and it increases the credit worthiness of the firm. Average payment period. Trade payable turnover ratio can be indicated in terms of average payment period also, which indicates the time or duration which is normally taken by the firm to make payment to its trade payables, and it can be calculated by dividing 365 by trade payable turnover ratio. The answer would comes in days, and if the answer comes in a fraction, that means you have to just make the payment on the next day. Suppose if the answer comes as 91.25 days, then we have this means that the answer would be 92 days. The fourth and the last turnover ratio is working capital turnover ratio. It can be calculated by dividing revenue from operation, or we may say net sales, by working capital, and the answer would comes in times. We can calculate working capital by subtracting current liabilities from current assets. This ratio is important for non-manufacturing concerns, where the current asset plays a major role in generating net sales. This ratio reveals or indicates how efficiently working capital has been used in making revenue from operations, or we may say that the number of times working capital has been rotated in producing revenue from operation. If the value of working capital turnover ratio is high, then this means that working capital is used efficiently, and if the ratio is low, then it indicates a bad condition for the firm. But at the same time, if the ratio is too much high or too much low, in both the cases the condition of the firm is at risk. It is not good for the firm at all. With this, I am going to end my video. Thank you.